If you're a police officer getting close to retirement, there may be a retirement plan rule available to you that you've never heard about. Actually, not even many financial advisors know about this. It's called the 3-year special 457B catch-up provision, and I'm looking to explain it all right here. As a retired police officer myself, I use this exact provision to save my whole vacation and comp time payout at retirement, all pre-tax. Then when I was in a lower tax bracket in the next couple of years after retirement, I converted everything into a Roth IRA. The end result was that this vacation and comp time payout was taxed much less and now grows tax-free within a Roth IRA with no required minimum distributions. For the right person, this provision can create opportunity to put away a substantial amount of additional money during the final few years on the job. A lot of officers know about deferred comp. They know they can make regular contributions from their paycheck. Some know that once they turn 50, they can make additional catch-up contributions. But many people have no idea that there's a separate 457B provision specifically designed for the final 3 years before retirement. And there's another part of this that can be extremely important. If you have access to both a 401k type plan and the governmental 457B plan, you may be able to max out both plans in the same year. Now, for someone who qualifies for this special catch-up 457B plan, that could mean more than $70,000 in pre-tax retirement plan contributions in 2026 alone. Now, that's a big number. It's not appropriate for everybody, but if you're in the final few years and you have income, cash flow, perhaps a large sick leave payout coming, it's worth understanding. I'm Chris from First Shelbourne, a retired police officer, and now I help police officers and other public employees and business owners make more informed decisions as they approach retirement. This video is for educational purposes only. It isn't individualized investment, legal, or tax advice, so always consider your own circumstances before making any financial decisions. Now, a governmental 457B plan, like the New York State Deferred Compensation Plan, has its own annual contribution limit. For 2026, the regular limit is about $24,500. That means that you may be able to defer up to that amount into your plan on a pre-tax basis. Now, if you're age 50 or older, there may also be an age-based catch-up contribution available, but that's not the provision I really want to focus on today. The special 457B catch-up is different. It may be available during the final 3 years before what the plan calls your normal retirement age. If you qualify, this special catch-up may allow you to contribute as much as twice the regular annual 457B limit. In 2026, that could be as much as $49,000 into the 457 alone. That doesn't mean every officer can contribute $49,000. Your available amount depends on your prior contribution history. More specifically, it generally depends on how much you were eligible to contribute in those earlier years, but did not contribute. So let's say an officer is planning to retire in 3 years. Over the course of their career, they contributed to deferred comp, but only when they could. So there were years when the money was tight. Maybe the individual had young kids, a mortgage, college expenses, or other responsibilities. They may have been eligible to put away more money in those years, but they didn't have the ability to do it. Now they're closer to retirement. The salary is higher. The household expenses may be more manageable. Maybe they're working overtime to build up more savings because they want to retire. So the special contra provision may let individuals use some of that unused contribution from the past, that capacity from earlier years. If you qualify and have enough unused contribution room from earlier in your career, you may be able to contribute up to twice the regular 457 limit in each of the 3 consecutive years before your designated retirement age. The New York State Deferred Compensation Plan has to determine your actual eligibility and maximum amount. Now, this is not something you should estimate based on a quick calculation or something you heard from a coworker. You could also max out your 401k. This is where a lot of officers may have a real opportunity. If you participate in a 401k, 403b, or a similar employee retirement plan in addition to your 457, the 457 has a separate contribution limit. So you may be able to max out your 401k type plan and also contribute up to the limit in your 457. For 2026, the regular employee contribution limit for each plan is $24,500. So if you maxed out a 401k and a max out of 457, the total could be $49,000. Now, let's take it one step further. If you qualify for the 3-year special 457 catch-up, the 457 amount could potentially increase to $49,000. So you could potentially have $24,500 into the 401k, $49,000 into the 457B, which includes the special catch-up provision, giving you a total of $73,500 in 2026 alone. And again, this is not a blanket recommendation. The 401k plan has its own rules. The 457 catch-up has its own eligibility requirements. Your available pay, your employer's payroll system, any employer contributions, and your plan documents all matter. But for an officer who has access to both plans, is within 3 years of retirement, and has unused 457 contribution room from prior years, this may be worth serious attention. One important detail: you generally cannot stack the age 50 catch-up contribution on top of the 3 years special catch-up. So if both are available, the plan generally allows you to use the one with the most contribution amount that gives you the most contributions. So you're probably in the clear there. So if you're 50 or older and you're also in those final 3 years before normal retirement age, ask the plan which provision gives you the greater available deferral. For many officers with significant unused contribution room, the special 3-year provision may be more valuable. Now, let's talk about something that can happen near retirement. Many officers may receive a lump sum payout for unused sick time, vacation time, comp time, or another negotiated benefit when they retire. Now, the details depend on your contract, municipality, department, and retirement rules. That payout is often taxable income in the year you receive it. So let's say you retire in a year when you also are working a lot of overtime, receiving your regular salary, and getting a sizable payout for unused leave. Your taxable income could be unusually high that year. For some officers, one potential planning strategy is to direct it into their retirement plans. The objective is not to avoid tax. The objective is to decide when you pay it. By making pre-tax 401k and 457 contributions, you may reduce your taxable income in what could be one of your highest income years. So, for example, if an officer can make $73,500 in pre-tax contributions between the 401k and the 457, that may meaningfully reduce taxable income for that year. But there are some practical limitations. Your employer must allow the deferral through payroll. The timing of the payout matters. Not every type of payout is eligible for compensation for retirement plan deferrals. And you have to arrange this before the money is paid to you, not after it hits your bank account. That's why this needs to be discussed well before your final day at work. Then, after retirement, your tax picture may change. You may no longer be receiving overtime. You may no longer have your full police salary. And depending on your pension, other income, and household situation, you may be in a lower tax bracket than you were during your last working year. Now, that may create an opportunity to do a Roth conversions gradually. Roth conversions aren't automatically a good idea, but they can be worth evaluating when income drops after retirement. The special 3-year 457B catch-up provision is one of those retirement rules that can be very valuable for the right officer, but many people simply don't know about it. Now, if you qualify, you may be able to put up to $49,000 into your 457 in 2026. And if you also have access to that separate 401k type plan, the combined pre-tax contribution could reach $73,500. Now, it doesn't mean you should automatically do it. You still need to consider your budget, cash reserves, taxes, pension, household needs, and retirement income plan. But if you're getting close to retirement, it's worth asking the question now, not in the final week on the job. Now, if this was helpful, subscribe to the channel. I'll be putting out practical, straightforward videos to help police officers and other public employees and even business owners make more informed retirement decisions. Everybody, take care and have a great day.